December 1, 2013 Real Estate Capital Scoreboard December 2013. Chicago, Illinois, December 2, 2013. The stock market hit new highs and treasuries climbed upward, yet mortgage rates held steady with 10-year notes rising by less than 15 BP and 5-year notes nearly unchanged. For the most part, lenders absorbed rate increases by dropping spreads. What's more, mortgage pricing differences between various types of properties and levels within the capital stack continue tightening as evidenced by the following long-term debt pricing summary as indexed over the 10-year treasuries. Leverage senior debt, 150 to 170 bits per second over treasuries for 65% loan-to-value or less, with multifamily and credit-tenant loans reflecting the lower end of the pricing curve. Lodging loans about 20 bits per second higher and 10% less leverage. Full leverage senior debt, 170 to 220 bits per second for 75% to 80% LTV. 75% applies to most types of commercial properties except for lodging, generally, 65%, and 80% targets multifamily/credit loans. Mezz/preferred equity, 300 to 1,500 bits per second for 5% to 15% additional proceeds, generating a combined 75% to 90% LTV. Overall yield, inclusive of fees, of 7% to 12% for lower leverage and up to 18% for higher leverage, more structured funding leaning towards equity yields. Joint venture/equity, 1,500 to 1,700 bits per second for up to 10% of the total proceeds. Overall yield of 18% or more for higher risk and new construction/rehab deals. Equity multiples of 1.5x to 2x targeted. Pricing heavily weighted on sponsorship, in addition to deal metrics. Underwriting. Since capitalization rates are at record low levels for most types of core and core plus properties, funding sources are turning to debt yields, 8% to 9.5%, and debt service coverage ratios, 1.15x 1.25, as minimum cash flow performance thresholds for senior debt. Mezz, pref equity, JV and equity funds often priced as low as break-even cash flow if projects demonstrate performance upside. Gene Peck, director of the Real Estate Capital Institute suggests, lenders are eager to lend. However, obtaining debt is much less of a problem than finding reasonably priced investments for most borrowers.